All right. So, good afternoon and welcome to the June 2023 Executive Committee meeting of the Board of Education Retirement Systems. Our first Executive Committee meeting in person in more than 3 years. So excited about that. It's Thursday, June 22nd, 2023, and the time is 1:09 p.m. As a reminder, please note that the committee meeting is being recorded and will be posted to the NYCBERS YouTube channel upon its completion. We'll start the meeting by calling roll. Anthony Giordano. Present. John Marich. Present. Donald Nesbitt. Present. We have quorum. I'd also like to note for the record that board members Mahisha Sapp, is in attendance, and board members John Dorsa and Allison Hirsch are also in attendance via WebEx. First item of business is to consider the minutes from the Executive Committee meeting held on Thursday, May 18th, 2023, a summary of which was included in your packets. May I have a motion to consider? So moved. Thank you, Tony. A second from John? Yes. Any discussion on the May 18th, 2023 Executive Committee meeting minutes? Hearing none, may I have a motion to approve the minutes? So moved. Thank you, John. Second, Tony. Any discussion? All those in favor, please say aye. 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 Any opposed? Any abstentions? Motion carries. Before we get into our first discussion, I'd like to note a few housekeeping items. First, as with the last two meetings, we'll be going in and out of public session. We have two items for public session, a contract re-up and the first part of the KPX presentation. Then we will go into executive session to discuss the second portion of KPX presentation. And because it includes assessments of vendors, managers, and securities, at that time, we will ask the consultants in attendance to either be moved to the lobby online or leave the room until the portion of that meeting is completed. Then we will discuss three fund opportunities for your consideration. Then finally, we will come back into public session for the asset allocation, the third asset allocation discussion. We have executive summary packets for those who are in attendance. We also sent one out for folks who online. For the rest of the presentations, everyone will receive the full presentation at the conclusion of this meeting. But we have some additional packets for folks in attendance who want to look at them. These are really just main points from each of the main presentations. Right? Any questions on that? And for the folks online, you will be able to see the full thing. We will share that shortly. Thank you. No other questions. The next item on the agenda is a contract for consideration in agreement with BCA Research. May I have a motion to consider? So moved. Thank you, Tony. May I have a second? Thank you, John. All right. So this is a contract re-up. BCA Research is a leading independent provider of market insights, analysis, and analytics across different asset classes, regions, and strategies. The Investment Strategy Department uses BCA Research for internal development of capital market assumptions and access to BCH Research reports and their strategists. NYCBERS is seeking executive committee approval to renew its one-year subscription agreement for an amount not to exceed $25,000. This amount was part of the recently passed budget. I'm happy to answer any questions, but the recommendation is to the executive committee to approve a outlay not to exceed $25,000. So moved. All right. Can we have a second? Second. Thank you, John. Any questions? All right. All those in favor, please say aye. 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 Right. Any opposed? Any abstentions? The motion carries. So, all right. So our next, So our next item on the agenda is the KPX presentation. And I do want to say a few words before I turn it over to Bill. Because I want to give everyone a bit of a framework on the pursuit of this the ESG pilot project and why the previous board and executive committees thought that a project like this could be additive to the overall ambition of the New York City retirement system's collective pursuit of its ESG goals in general, and I think climate goals specifically. Oftentimes I think, when we have discussions around, the governance structure of New York City's retirement systems, it's oftentimes talked about in a bad way, right? But I actually think that in particularly in nascent spaces, having these type of pilot projects and having kind of this diffuse governance actually works well for our overall collective ambition. And so the previous executive committee and the previous board of trustees thought as we're thinking about how collectively the New York City retirement systems through the Bureau of Asset Management really help us execute on the net zero climate action plan, there are some really interesting smaller groups and opportunities that I think can be additive to all of that. And so after numerous discussions with the previous executive committee, the previous board of trustees, we landed on the KPX ESG private market pilot project. And I'll let Bill go through the details of that pilot project, and he'll share his presentation in a second. But just wanted to give you an idea about kind of how this was germinated and why we think it can be helpful in our overall pursuits with the teachers' retirement system in NYCBERS. And so with that, I'm going to share screen and I'm going to turn it over to Mr. Bill Mills. Can everybody online see my screen?
Yes, thank you, Antonio.
Yes, thanks, Antonio.
Beginning. All right, so Bill, floor is yours.
May I stand up?
Absolutely.
I'm so old school, I carry a briefcase and I've got Medicare, but it sure is nice to be back in person. I mean, I'm so used to it and I so much prefer in-person presentations. So I thank you all for that opportunity.
Give me 1 second on this. I just want to note for the record that Quinn Apollone is in attendance.
And if you would mind, Antonio, if we could just go to the first slide.
Absolutely.
And keep track of my time. This is the context in which we were retained. And just briefly stating is in review, the climate action plan and the implementation plan, in a word, in our view, is extremely aggressive. It's also very motivating in that if you all are able to achieve what you've set out to achieve, it will stand as a sterling example to other people that are trying to mimic their same actions and same processes that you all have adopted. And from a selfish point of view, I hope you understand how much fun that is to work with a group that's not afraid to step out. It sees a need to step out a little bit and explore other alternatives. And we thank you for that. The demonstration project focused on 4 private security managers. But just as an aside, 27% of your portfolio is made up of individual managers who are buying and selling out of the private securities market. And 79% of those are in general partner and limited partner structures, which brings a bit of legal definition, if you will, in terms of how you can relate with those holdings. It's a bit of a complication. And we were mandated to recommend actions to align and comply with your net zero implementation policy stemming from that work that we did with those 4 managers. Antonio, please. But I have to admit to you that when we started out, I hope you find this of value, we had a vision also of what we would like to achieve in doing this type of work for you all. And that was, we wanted to enhance your all's ability to meet your primary obligation, and that is to fund for your beneficiaries. When we went through the process of interviewing the fiduciaries to determine their priorities, there were 2 gentlemen, and this was a fairly lengthy interview process that said, we can't forget the fact that we're in business to fund for our beneficiaries. That was the top priority. But what we also wanted to do is whatever we would determine and find from a view of those 4 managers, we wanted to be able to share with you thoughts that we might have that would be able to accelerate the timeline from which you all could actually comply, move the private strategies to comply with your net zero implementation plan. And not only accelerate the privates, but if in fact we are successful in doing that, you're also accelerating your timeline for complying with the whole. The sequence of work that we followed, I mentioned it earlier, we interviewed fiduciaries to determine from them what the 4 top priorities were. Key point being 2 things I would add here. The fiduciaries were using their own experience and their own knowledge instead of that of the beneficiaries. They weren't trying to decide what the beneficiaries wanted to do, but it was in their best judgment what would be best. The reason why that's important, one of the conversations that came through all of us is they were saying, you know, if New York City does well, then the Board of Education retirement system will do well, and therefore we'll be able to serve our beneficiaries. So you see that the priorities that were determined as a result of those interviews did border on climate, did border on diversity, did border on transparency. But the fact of the matter is the orientation on every bit of that is what benefits New York City. And by extension, what benefits the plan, and by extension, what benefits the beneficiaries. from those 4 priorities, and Professor Hepner will speak to this later, we developed analytics that spoke to each of those priorities. Now, what was different in what we developed is they were all unique. They were material. They spoke to important issues embedded in that measurement device. They were dynamic. It wasn't something that you were going to come up with and not remeasure for another year. Some of these analytics, if you so choose, change daily, change weekly, change monthly. And if in fact they relate to priorities that you as fiduciaries thought were important, why should you not be able to measure those currently? To identify that was a priority, diversity, yet you couldn't review somebody for another year and a half? That's a priority without a real purpose. So one of the deals that we were trying to gain by developing these analytics was the ability to update frequently. The circumstances do change. And as I said before, they have to be relevant. And what you'll find, just as importantly, we could have done all 3 of these things, but we failed miserably if Professor Hepner couldn't relate the analytics to what you were holding. What if you just came up with great analytics and they mapped to 5% of your holdings? Well, good luck. It did nothing. So one of the objectives that Andreas had was, let's make sure we have a high mapping. And then finally, if we knew what we wanted to do and where we wanted to end up, Mark will speak to this point. Those 4 managers that we worked with, how do your priorities, how do these analytics correspond to what they were hired to do and what they can do? There had to be that mesh because they work for you as agents. And so in this room, you could identify anything you wanted to do. But if your agents who were working on your behalf didn't know what that was or how important it was to you, it's the same thing with the taxonomy of giving you 5% taxing. So what? So this was clearly important. This was also important in that we felt privileged by being given the information that we did. We saw what Axia did. We interviewed Axia. We saw what everybody did. We saw what the Board of Asset Management does. Our vision was, and I think we're successful, is whatever we wanted to make in terms of a recommendation, it had to be additive. To be duplicative or instead of, quite frankly, was insulting. You all had the best people you can, and you have. So whatever we wanted to do had to be perceived as adding to the total. Consequently, the things that we identified as enhancements, because it's still in your purview as to whether or not you want to do it, was not only the analytics and privates, but the systemic risks. The interviews that we had with fiduciaries, as well as is in your policy, you're very much concerned about what's called just transition. If you make a 0 greenhouse gas emissions goal, what happens to the jobs? What happens to, in our case, we looked at gentrification or low income housing in this city area.
Bill, just a quick question on that point. Usually in this area, one also considers the physical risk and the transition risk, which also takes into account the public policies and the governmental support in being able to meet that net zero goal. Is that part of how you're defining just transition?
That's certainly how I would define it, but we haven't even begun to get into actually doing that yet. But I would define it that way. What I'm relating to here is basically what is stated in NYCBERS investment policy. And that net zero and greenhouse gas emissions are a critical component, but they also make note of the fact that they're a universal investor. And they also make note of the fact that the transition associated with getting to zero carbon level has ramifications beyond simply reducing that. It's something that the group noticed, the fiduciaries noticed as a risk. Analytics can be developed to measure that risk across the portfolio. But what we were focusing upon were these first 4 priorities, the analytics developed, and how it's applied to these 4 private asset managers. But that's a good question and it very much has a ramification.
Go to the next slide. Go to the next slide.
Real quickly, the due diligence. Again, BAM and Axia, we think are doing very good jobs in this. But the question comes, you've got to be able to tell the agents what you want done in your behalf. So there is some room for ESG due diligence, which among other things, because of the analytics that have been developed, you can actually look at model portfolios as part of your analysis. And probably most importantly, let them know the climate goals. And then measure that, inform them, work with them as you go through the, what is at this point, the engagement with the general partners. because I think you can build a universe with these analytics. You'll see because of the tracking and the taxonomy, and get the commitment to improving at the time you give the money to the asset manager. These are long-term goals. 2040 is very aggressive, but the fact of the matter remains is 17 years in advance. Nobody's going to get you there today. That is very valuable for them to know where you're going and what steps can be taken in the meantime incrementally to get you there. Now, Antonio, I'm sorry. In executive session, these will be talked about. Diversity, gentrification, net zero reporting and transparency. Professor Hefner, who is on, and then Mark, who is sitting there, will go through the detail of the service provider assessments. And I would leave you with this thought. I think it's fairly simple. We started with the interviews. We identified through your all's eyes what was important. Then we innovated in building those analytics. Once you have the analytics, you can inquire. Once you have one of those asset managers that say, this is what we're holding, this is what we think is important, here's a gap, inquire and discuss that difference and how you close that gap over time. Again, it's not something that should be expected to happen immediately, especially in this case if the manager doesn't know where you're going in the first place. And then the influence comes about through that conversation. Because in the GPLP structure, if you're able, you're not going to be able to get out of an investment if a particular company is not doing what you want. But you can start exercising an influence through the side letter. You can exercise a lot of influence if that GP knows what you're looking for, because they come to you with the next fund and the fund after that and the fund after that for money. Now they know what you're looking for. And you know what they also know? Because your group of this size is telling them what you're looking for, it's a competitive advantage. And they will respond to what you want, I believe. Already touched upon these, but potentially, and this is a key thing, additive features could be out of this limited project consideration, identifying the fiduciary priorities. If that happened today, why would you not do something like that every 2 years, 3 years, 4 years? Because people change and priorities change. What we hope to prove is regardless of what those priorities are, you can develop analytics that define it. And why not? If you know the priorities, why not run it? Say, this is our priority and this is where you are, Mesero. Let's close that gap. Just Tony.
Yeah, so sometimes doing the right thing is painful, and there'll be dips before we ultimately get to where we want to go. I think it's important, though, that we know that. Obviously, on the public side, it's much easier to quantify. On the private side, is there going to be some way to determine what our opportunity costs were, what the cost, what the short-term cost of this maneuver is versus, where ultimately we want to go down the road, just to have all of the information, not be Pollyanna about the realities of life.
Great question. I love the expression Pollyanna. Yes, the opportunity will be there. And I think the implication in your question is that, again, you can't change overnight and it's difficult to come out what you've already invested in, which does not mean that you shouldn't have that conversation with the manager to know what your future looks like. And that's what we would emphasize, because once they know what the future looks like, then you do have the ability, whether it's through these analytics or other, you define the goal and you define what's important to you. And once you've done that in a way that they understand it with these analytics, and you'll see when Andreas goes through them in a minute, they're different, but they're approachable and understandable. Antonio, please.
Actually, one other thing I'll say, Tony, is that one of the great things I think about still the, and first let me know Sri Gibson has arrived for the record. And one thing I want to say is that some of the modeling we're doing as it relates to asset allocation and Salil's investment liability risks, we've talked about how do we layer on all of this, right? And how I've tried to like it is that we have an explicit or implicit active risk budget. We have an explicit or implicit how much you want us to deviate from kind of your baseline, either that's the asset allocation you choose and kind of the ultimate risk and reward characteristics. And so if we can think about it in that, then it's not completely a one-to-one, but I think it's our priority is still we have to get the return. I mean, that's the thing. And just because I say that you give us the constraints, we'll build your portfolio, right? Like that's really what it is, right? And so understanding those particular trade-offs and whether or not you end up having to take more risk or the portfolio looks a little bit different, but having that conversation kind of out in the open and characterizing it as a way to, as just another kind of building block or another part of mosaic of building the portfolio, I think is important. It's in either the Bureau of Asset Management, Axia, Siegel, Marco. We're going to tell you it. We're going to tell you what's good, what the trade-offs are.
And on a asset management level, we have some kind of idea of what an alternative portfolio that would have been, had it not been that, some method, some mechanism for potentially seeing where, and look, ultimately, we know where we need to go. But I want to know the full scope.
Absolutely, and I think, and to answer you, to let Bill kind of finish up the presentation, the one thing I will just say there is, I think all of your service providers kind of build that, and I think there's a number of ways to kind of build that baseline, whether or not it's just the kind of that model portfolio. I think that it's an incredible, I think it's an incredible opportunity to not necessarily have those trade-offs, especially in the early going when we're talking about measurement, right? And just understanding those obligations. And I think, there is are we meeting our ambitions? I think at the end of the day it should be the baseline for you all. Allison, you have your hand up.
I do. Thanks, Antonio.
Most of the information that will go into these types of analytics, private equity managers already have. They have started incorporating material, environmental, social, and governance factors in the way that they price the companies that they buy, with the thought that, for example, if we make them more energy efficient, we can ultimately sell them at a higher price. So most of the information that you will be looking for in doing this type of work, the managers have in hand. They've hired people to track and do this, and it's part of their investment process.
Absolutely. And Allison, can you, again, we didn't hear, I had to turn up the volume.
Sure. So
Yeah,
I just wanted to flag, I don't know whether you announced his presence here, but also on the WebEx is John Adler, who is the
We're having issues
Chief
with folks online being able to talk.
Oh, you can't hear
I
me?
don't know if we get somebody from IT, because we're having issues with hearing folks.
Allison, I can hear you. However, I don't know that the people in the room can hear you. There might be I think Antonio is trying to get the issue troubleshot.
Thanks,
Allison,
Alex.
can you guys hear me?
All right.
Yes,
Allison,
yeah.
try one more
Professor
time.
Hefner, we can hear
you-
you. Antonio, can you hear us?
I'm so glad to know that you hear me because I would have otherwise come up.
Still not.
I'm sorry, Professor, we can hear you, but I think the people in the room cannot hear the remote participants. Antonio, can you hear us at all? Anyone in the room, can you hear us at all? Okay, I think the
I don't
audio in
think
the
they
room
can.
needs to be troubleshot.
Yeah.
All right, give us 1 second, having some technical.
The good news is we know where it needs to be troubleshot. I would have panicked in 5 minutes if no one can hear me.
Yeah, you did. I know.
Later.
Yeah, exactly. Yeah, we cannot hear, right now, we cannot hear the online participants. We're getting IT right now. Hey, Andreas, we're getting IT right now to come and figure out the issue here.
Allison, did you want to
I'm
drop your
I'm
question
putting it in the chat
maybe?
right now. I'm
Great,
typing
great.
in the chat right now.
What's in the message?
It's a technical
I want to
question.
dial in.
I can answer that in the
We can do
meantime.
that. They can move over here. But they'll hear it, probably they'll hear it twice. Yeah, probably hear it twice, feedback. All right.
State plan as well as put you down at a time. George Sarah.
All right, so, and just so you know, and I let the folks know in here, but also John Adler, Chief ESG Officer from the Bureau of Asset Management, is also online. He's the architect of the Net Zero Climate Action Plan, the implementation plan, and the portion in our investment policy statement. So kind of the architect around that ambition came from John Adler. So obviously, if you have any questions, make sure that you reach out to him on both its kind of development, what the Bureau is doing on their end, to kind of help us fulfill that ambition. So we have somebody from IT here right now to help with the testing the. Oh, you have the logitech right there.
First, we have one, so we must write to be defined.
Whole mustache.
Oh, thanks.
I've had it for 51 years.
I'm 50 years old. I can't grow a mustache or a beard. It's like,
Yeah, can you hear me on the other side?
My first job in college.
We can hear you. Can you hear us?
Andres is trying to talk still.
Can you hear us?
So my first day in, my manager goes, Mills, gotta get that damn thing off.
We can hear you. Can you hear us?
Irreverent, I like it.
An activist.
I don't think they can hear us in the room still.
No. I'm gonna go on video for a minute so they see when they should hear us.
My wife's from Kazakhstan.
Waiting.
Twice.
I see. You said my wife.
Mute it on. Problem is it sound wired all the way around, right? So they can,
We can hear you very, very well.
So we've had it working with Teams, not so much with WebEx, not,
yeah.
Trying to be more efficient. Sometimes my attempts to become more efficient. It's literally anything.
But I always know what it's. And
So do the meeting in the back or?
some of that doesn't.
Host, you do it in 3 seconds.
10 minutes, no, it's like 2 hours.
I can do it. I can.
Might need.
I'll
I'm gonna think if we could dial in.
It's not about
just.
Yeah,
And then, they hear, maybe they'll think they'll hear twice.
Put myself in his hands.
All right, so what we're gonna do is we're gonna mute here and dial in so that we can hear you guys. Okay, thank you for your patience.
That sounds good.
Like to Coney Island Aquarium. Water sand. 3 seconds. An hour.
Satisfaction.
Welcome to WebEx. Different codes are owned by
And you got to sit still.
You can use mine.
Thank you, my love. I appreciate it. Thank you so much. It's the waste versus, the cost benefit analysis essentially.
Okay, then we'll kick everybody else out though. That's the problem. So, all right, Andreas, can you talk?
Can you hear me?
Go one more time.
Can you hear me?
We can, but not very well. We're just trying to figure out how to get this done. Because yeah, the issue, the room, you guys can hear us fantastic. And we can't hear you guys at all. And so I think we're just
I
gonna
can
have
hear you well
to.
when you're next to the mic. Shall we?
That's better.
Yeah.
Yes, that's better. That's better.
All right, so everybody on the phone, you can hear Andreas?
Yes, we can
Yes.
hear him.
Okay. Okay. All right. So I think we're gonna have to do it this way for now, as folks are presenting, and then we'll switch over when folks in this room are presenting. Okay. No, we can't do things right now, so we're just gonna have to do this for now. All right. For now, for when somebody's on the web and it's presenting, we're gonna use this way, but we can switch back when somebody else is in the room presenting, just because we want them to be able we need to be able to hear them. So, all right. So apologies for that. So that's how we're gonna do it for now. Apologies for the first meeting in 3 years in person. So some AV issues. So thanks for your patience there. Okay. So if that, Bill, can you wrap up and then we can give it to Andreas?
One more slide.
Yeah. Okay, so let me reshare. My screen. All right. Okay, go ahead, Bill. All right. All right, guys. Go back.
Let's go to the
Left. Yeah. All right. Absolutely. So, all right. At this point, we're going to go into executive session because we're going to be talking about securities and managers. And so I need a motion to move into executive session. Motion. Thank you, John. May I have a second? Second. All right. Thank you. Thank you, Cherie. Any further discussion for public session? All right. All those in favor of entering executive session, please say aye. Aye. All right. Any opposed? Any abstentions? All right. The motion carries. Before we do our final item for the day, we report out executive session. In executive session, the executive committee approved 2 private equity funds and tabled a real estate fund until the July 13th executive committee meeting. All right. So, perfect. So our final item for today is our discussion on asset allocation. And we're going to do this in 3 parts. The first, and because you've all waited so patiently, this is we're already done at 27 minutes over. We actually have quite a few folks from our from Siegel Marco Advisors, our general consultant here today. We have Sue Crotty, who's the Chief Investment Officer of Siegel Marco. And also online we have Frank and Frank Salamoni. Is he still on? He might have. Oh yeah, Frank's here. Perfect. Frank Salamoni. And we also have and Christian Severe as well on the line today. So thank you all for coming in. And really, in this first part, we just wanted to give updates to the executive committee on where we are in the asset allocation process. And any kind of work there as we work with them in the Bureau of Asset Management and bring a recommendation to you all sometime in the 3rd quarter of this year. So, Sue, Frank.
Thank you. So we have been hard at work going through the review of the potential new asset allocation. I'll just make a couple of comments on what the year looks like because there's a very large change in capital markets that has occurred over the last year as a result of the rising interest rate environment. So where we started this process, a while ago with you when interest rates were essentially at 0, we've had 10 interest rate increases. And what that does is basically takes a 0, which was kind of your base case risk-free rate, and it went all the way up into the 3s when we started doing the capital market assumptions early in the year. So essentially it's almost a 3% boost, which, raises all the boats. So the good news for you as we've gone through this work is that it's actually easier to make your target return, and actually you can do it with less risk because you have a risk-free rate that has risen. So it's a little bit easier these days to do these sorts of asset allocation studies in that, you have a much better interest rate environment, a much more normal interest rate environment than we've really had in 15 years. So that's the good news. So as a result, I don't think you're going to see things changing dramatically. You can get to your target returns, on a risk-adjusted basis, even better than you could last year. So with that as a quick summary, I'll take any questions that anyone might have about the environment.
Questions for Sue?
So we're in the final stages of reviewing and, going back and forth with staff on some final adjustments to the mix, and we'll be providing them to you at a later date.
Just in terms of the overall asset allocation perspective, how are you guys because it's part of the conversation for today? How are you incorporating ESG elements into that as the overlay of the asset allocation program?
So that's in the implementation more than it is in the actual numbers, because this just says, this is what we expect for bonds, this is what we expect for stocks, this is what we expect for private markets, etc. And then once you have that, and you have to find the managers to fill the bucket, that's where all our ESG factors would start to come into play.
Do you look at external, like I know the United Nations have developed some sustainable development goals around climate and so forth. And you have countries, you have companies that signed on to those targets. So are we internally driving that, or are we kind of anchoring ourselves onto what the larger space is?
I think I can, mind if I take that one. And we made, the July 13th meeting is shaping up to be a pretty long one between Blackstone and we're gonna do the Linux Park, developments. We're also looking at, and again, I want to call to your attention, and this is all on SharePoint, but we might be able to start putting into the executive committee packets as well. And we'll go forward on this because the last group of executive committee members, trustees wanted like 5 pages in that packet. We need to get it to be, longer to make sure to address all the concerns we will. But on the SharePoint side, currently we do have, this is put together by John Adler and his team, kind of an ESG kind of compliance checklist that goes through kind of the policy in a little bit more detail. And so that's also in each of the packets for each of the managers. And then as far as the UN Sustainable Development Goals are concerned, this is mostly for the public markets, but the platform that we utilize, Clarity AI, does rate managers' portfolios across the UN Sustainable Development Goals. And we'd be happy to kind of show you all that. I'm hoping that we can maybe after this meeting, if you have any time, we can show you what the platform looks like and how we can best kind of get that information moving forward. Although again, I would say it's part of the
maybe we can use Blackstone as a sense.
So interestingly enough, we can use Blackstone for the I think there's a lot to it. And then obviously there's Article 9. So there are other ways to think about that as well. And so hearing all of the kind of the comments, we'll make sure to start incorporating more of that into it.
I think it would be to the point of common language and the move to not just theory, but application to maybe give us an opportunity as board members to interact with the platforms as we discuss. Because it's a ton of information. I think a great cover for the investment companies would be great where they're standing, especially if there's a comparative or third-party ranking around certain topics. So it's independent and unbiased. Like my father said, fisherman never says it's fish Spain. So it would be good to get a third party view of them. And then as it comes to kind of the investment itself, if there are these platforms that you guys are, using or incorporating, it would be helpful for us to get a better understanding of how are you seeing it or your manager seeing it as we kind of both connect all the dots.
Some of the common standards that are evolving are ones you're referencing. One that you typically see the managers use as a starting point are the UN principles of responsible investing, which on a certain level are quite high, but over the past 10 years, it became very clear that every kind of dog and his daddy could sign on and be a signatory. It was more marketing than anything else. But the folks working at the UN for the principles of responsible investing said, okay, we're actually going to develop and measure and see who's living up to them. And it's a pretty exhaustive process at it. But you basically, if you sign up these days, you get scored on it as a manager, and those scores are available, and they also can be a starting point for improving in certain areas.
I hear they have a ton of resources, training materials,
They do.
Best practices. So it's not that it's just punitive if they don't.
So we are currently not signatories of UNPRI. However, when I was on the board of NYCBERS and teachers, of the 5 funds are, and it's interesting because a lot of times we go through the bureau, but I believe that the funds themselves have to sign it. Now it costs money, so I have to say that we have to be mindful given our budgets and everything like that. But it does cost. But they didn't come and do trainings for everybody. So when I was on the NYCBERS board, they actually UNPRI came to our offices, gave the trustees training around how to use their platforms, what they're measuring. In fact, one old NYCBERS trustee was one of the founding members. Mike Muzaraka was one of the founding members of UNPRI. So a New York City trustee was all like there from the very beginning. So that's an option. I also know it costs money. So wanting to be mindful of that as well. But no, definitely. We'd have to start by becoming a signatory. Um,
Then the targets might.
absolutely, absolutely, absolutely. All right, so any other questions for Sue or the folks from the Siegel Marco team? So before I pass it off to Axia to go over the pacing, which is I think the final, the next portion of our discussion on asset allocation, I wanted to kind of very quickly go through, you know, the building blocks of this discussion, right? And it's a very quickly. So just very overview of key takeaways and the pacing analysis update. So each step of the way, we've been trying to build up to the ultimate asset allocation recommendation. And so just as a refresher for everybody, we looked at our historical asset allocation. So kind of how did we get here? Put more alts, so more in alternatives in private markets, less in public equities, more in US equity, less in international equity, more in credit, so more in kind of in less in kind of government treasuries. That's kind of been the theme over the last 10 years. But now we're in a better financial position. Improved funded ratio. Again, that last chart I showed you two sessions ago, we went from 54% funded to 100% funded over that time period. The contributions are at their lowest level since 2009. But on the flip side, we are cash flow negative. We now are a mature plan as of 2 fiscal years ago. And this was the presentation that Siegel gave at a previous meeting. Macro considerations, and this is what kind of Sue has talked about: rising interest rates to combat rising inflation, lower global growth forecasts, valuation down in public, and there's some tempered interest in private markets. Our current portfolio, using the capital market expectations of our consultant, at 7.9% expected over the next 10 years and 7.5 over 20 years, with a standard deviation of 13.2. So kind of the volatility or how we think about risk in the portfolio. Salil gave a presentation as well. So the deputy director gave a presentation, basically how we're incorporating liability risk modeling. And so thinking about the other side of the balance sheet, thinking about benefits, not just on the asset side. And so we're taking account additional parameters. And essentially, in certain aspects, it might be more costly if we get it wrong. And so we think we're close to our appropriate risk tolerance already. If not, can take it down a bit. As we start to think about the other considerations, climate change, diversity, and inclusion, we have to start thinking about how that is incorporated in our entire portfolio. And so that means that our, what we call our tracking error, our differences from the overall market will increase, which again, we're not saying that's a bad thing. We're saying that is something that will happen, and we have to take that into account. And then, again, the current indications are we're probably going to take down risk, right, in the portfolio. And then we had the actuary gave a presentation and gave actuary basics, contributions plus investments equals benefits plus expenses, and kind of gave the equations on how the actuary sees the world. They're an important component to all of this. There's a ton of smoothing methods. This is for your consideration. We have a ton of smoothing methods that spread the market and active risk over time, so we don't blow up the city's budget, right? Like that's really kind of why it's useful. And then ultimately, we have this big group amortization payment. So extra payments that were being made over the past 22 years are going to end in 2033. So we see a big flip in the amount that the city is going to contribute if things as we've been working with Siegel, and as we've been working with the Bureau, and as we've been working with Axia, we've settled on kind of, all right, we've said we're going to take down risk, but what does that mean in practice? And for us, it can mean two different things. Either we rotate, that means we take from public equities and move it into fixed income, right? So less volatile public markets into, more volatile public markets into less volatile public markets. Or we rotate from alternatives to public markets, and that has cash flow considerations for us. Essentially, risks manifest themselves in different ways in private markets. You don't see the big markdowns, but essentially we just don't get our money back, right? So like they just hold on to it longer and longer and longer and longer. And as our cash flows are declining, what does that mean? We're not saying we've settled on anything yet. What we are saying though is that if big picture, and as the executive committee, as the board, big picture is the name of the game. Big picture, here are the kind of things that are kind of pulling on us is how do we take down risk, and what does that risk mean between volatility of the assets and our cash flow considerations as the contributions from the city drop after we were ending that 22 years of extra payments. So with that, I'll turn it over to the folks from Axia to, let me stop sharing my screen for a second and reshare, to go through the next portion of this, which is our pacing analysis. And the pacing analysis discusses how much money we commit every year to private markets. And kind of says to maintain, get to or maintain our target weights in each of those asset classes. That's important because that's kind of additional money that's going out for commitments every year. And again, with the chance of higher return, but also risks that manifest themselves in different ways. And so with that, I will here go to the pacing analysis. Right. So we are here for the final presentation. And Sandra, are you taking this one?
Yes.
All right. So let
Happy
me
to do that.
actually.
So thank you for setup of taking us through how
Sorry.
you think about arriving at your strategic asset allocation. And I guess I want to start by saying that we're doing something much more simpler. Pacing is really just a budgeting exercise to figure out how much money you need to put out each year to meet your strategic asset allocation in a private markets portfolio. So the last time you went through all the effort of doing your strategic asset allocation was, I believe, in 2020. And so we are using the numbers from that time for each of your private market portfolios. So for example, currently your strategic asset allocation target for private equity is 9%. And what pacing exercise does is saying, if Bears wants to maintain their private equity portfolio at 9%, how much money do you have to commit each year to keep it, reach it and keep it at 9%? So again, maybe I'm being a bit of a broken record. All what we're doing is really a budgeting exercise to show you potentially how much money you need to put out each year to maintain your strategic asset allocations in your private market portfolios, which are essentially private equity, opportunistic fixed income, and your real assets, which are two flavors of real estate and infrastructure. And
The private equity?
yeah, and just conceptually, the way that you arrive at this is basically, as a plan, you're thinking about the money you're putting out to meet your capital commitments, which are your capital calls, versus when the money is coming back in, when these managers sell the companies or their assets. And we're solving and forecasting relative to the growth rate of your plan. And since your actuarial rate is key for thinking about paying your benefits, we tend to follow that 7% growth rate for your plan. So the stuff that goes into these funny looking charts is really just how much, projecting how much money you'll be making in capital calls to your managers versus money coming back to you from the sales of what they own relative to the growth rate, the net asset value for your plan. And again, what we're solving for is at this point your current strategic asset allocation, private equity, which is 5%. So the very busy chart down there, that dotted black line is your 9% strategic asset allocation. And you're currently overweight, largely from what happened in the public markets over the last 2 years, called the denominator effect. So your actual allocation in private equity is around 12%. So we're solving in our pacing model to see how much you need to put out to get you back down 9%, over a 5-year period with assuming a 7% growth rate for your overall plan. And basically the answer to that is you would need to put out approximately 180 million each year. Now that it's going to be divided up between the managers you want to re-up with, such as what we discussed today, CDC and EQT, and potentially new managers. We're also aware that you run a very fine emerging manager program. So we also split it out between your core managers and your emerging manager programs, such as Northbound, the one that's being managed by Neuberger Berman. So all of this is really just a budgeting exercise to say, as you rebalance back to 9%, for your private equity portfolio, you would need to put out still about 180 million per year. Ultimately, in 5 years, get you back to that target.
What's the best cost change? We're still reducing it back to the 9%.
So, and that's why, like, talking about how we conceptualize risk, it's weird, right? Because if you think about why we went so heavily into alts in the first place,
Right.
was when rates were low, right? And so, now again, the two kind of competing ways we're thinking about kind of risk is either, again, rotating out of public equities into public fixed income, or again taking some of the, I'm gonna call it liquidity issues because that's putting it too strong. More of that we've had 22 years of very high contributions from the city, right? And that is starting to decline, right? And we hit our peak in 2019. Contributions to the city is going to decline every year, and that's a good thing, right? Like that's a good thing. We've made great investment returns, all of stuff. That's fantastic. But also, what it means is that, you know, if we have a drop, for instance, in 2033, at the time we're getting no money, right? Like that's something. Again, that's all. These are all on the, I won't say on the margins, right? But they're important decisions. And so when we talk about rotating out of alts, maybe again, we're not close to having a finalized recommendation yet. We got the basket clause expansion almost like after right, like what, like we needed it, you know, 5 years ago, right? And we got this expansion after we kind of hit our targets. And again, there, you know, the models that we're looking at have some drops, some have an increase as well, right? And so I don't want to pigeonhole it there yet. What I'm saying is that as you're all doing your deliberations, these are the considerations that we're thinking about. And so as it stands, but the other side of it is that if you look at 9%, we put out $355+ million, right? That was the target a couple of years ago. So we're talking about a reduction of 50% to get back to target. And what does that mean, right? What does that mean with regard to the amount that we contribute, the number of managers? Again, we're not saying we've solved or had a solution yet. What it means is that those are the type of considerations. We have a $25 million minimum usually, right? We have some exceptions for certain managers. What does that mean for the minimum, right? Does that mean that all of those things are
We have a study coming on that too, right? Don't we have a study?
We do. We have a study going on kind of optimal, right? But that's, you know, kind of one layer optimal on number of commitments in PE for diversification purposes, but not like kind of overwhelming manager selection. But I guess that's what I'm saying is that, like, if you see that 180, I actually think less about the target and more about the 180. That's really kind of the thing that is most, I think, relevant for this conversation.
And, you know, if you were assuming a lower growth rate for your plan, it's not going to be also to show that on the slide. So again, it would be just a $40 million. So if the growth of your plan is slower than you're seeing your actuarial rate, which is used strategic asset allocation, sensibly would be used. Now, if we go to opportunistic fixed income, here we just summarize on this page, same information you put out 180. So kind of showing you more details around the cash flows and valuation. Yes. Now, you're kind of behind the 8 ball. Opportunistic fixed income, primarily for 2 reasons. One, BERS started this portfolio almost 10 years later. Most of the other pension systems did. So you're kind of the new kids on the block. It takes a while to ramp up any private market portfolio, including private credit. And in addition, Antonio and his team have carefully thought through about, you know, how to build this portfolio and what kind of loans and other debt instruments they want in. They have thought about middle market direct lending as being a good risk-adjusted opportunity, but kind of in the overall pipeline that is coming through BAM, there hasn't been that much middle market direct lending. And as generally you think about opportunistic fixed income as being a diversifier relative to private equity, because you will that money back coming from the interest payments on the debt instruments. It's not as liquid as PE strategies. Um, The strategic asset allocation target of 5% is underweight. It's currently, I tell you, it's what, about 3.5, 3.6. And even if you put out between 180 to above 200 million per year over the next 5 years, assuming that 7% growth rate, you still will be underweight in that area. And so that's also something to think about relative to the opportunities you're seeing, private credit, opportunistic fixed income, how you think about it as kind of a diversifier to your high octane portfolio. And if we do this also at the lower growth rate, the messaging I'm putting out a good chunk of change, you still will be underweight. So this may also, we've talked about this, lead to constructive discussions around perhaps seeing more opportunities in middle market lending as well, so that you can also take down the bite sizes and the kind of managers and strategies you're seeking. Now, if we go to
Go to infrastructure next, or we'll go down.
yeah, and yes, infrastructure, 4% strategic asset allocation, pretty much there. And going forward, basically, if you commit 100 million to your existing managers and potentially new ones, you will pretty much stay within that 4% plus or minus 1 strategic asset allocation. It's not that different if you lower the growth rate for your plan slightly less. Now, in real estate, the overall real estate portfolio is 8% strategic asset allocation. It's broken into lower and higher risk buckets. Core is lower risk, and non-core is opportunistic and value added, which is higher risk. Generally involves more borrowing at higher amounts and kind of more building development. So that's why we kind of break out the two parts of your real estate targets into two separate buckets. Now, the main message here is, while overall you can think of it about 8% real estate, it's broken out 4%, 4% in your strategic asset allocation. And if you look at where you actually are, you are overweight at 6% for your core real estate strategies. And to kind of rebalance, even at this point, if you put out de minimis commitments, you're still going to be a little bit overweight. But since you're very cognizant and thinking about how to rejigger your risks at your plan level, core real estate is, you can think of it like in a liquid bond. You're owning buildings, you're making money from the rent coming in, no development involved, no borrowing money. So you can kind of think of it like a liquid bond. So that's really clear. While we're saying, rather than, forcing money into what is overweight situation in a very low risk real estate strategy, we're recommending that we go to the non-core to really make the capital commitments going forward, reach that 4%, that overall 8% bucket, to your opportunistic and value added real estate strategies. And so they're, roughly staying around 80 to 85 million will allow you stay within the bounds of your current strategic asset allocation for your higher risk real estate strategy. And again, we just show them under two different growths for your
So we don't have a problem from bucket to bucket.
It's really your call, because generally real estate is that big a liquid bond at 8%. We just recognize that core is really safe bond-like terms. You're opportunistic, you're borrowing a lot of money, you're building things, you may be borrowing.
Low risk.
Yeah.
Is there an opportunity to double this with potentially like going with green real estate?
Absolutely, and I think as you started to see, the Bureau started to bring, in the EQT Future Fund, the green credit funds, and so those have started to come. And so I do think that will absolutely continue. I think that, overall, I think what we wanted to take away from this is, and as we're kind of redoing the pacing analysis, is really, we're coming to some questions. Like, we've been used to seeing 3, sometimes 4, 5 managers a month, right? So we were putting out so much capital every year. I want to say that across asset classes, we were committing $500 million a year, right? Just to give you a sense of where we were. And that is declining. I think if you add up all that, that's what, 182, 60. In private equity it was 355. Now we're looking at 180. And what that means for the number of managers, the sizes, what decisions we have to make about who stays and who goes, as we're trying to add in those new strategies, like from an ESG, diversity and inclusion perspective, right? So it's a big conversation. It's a big conversation. And even if we increase to like 10 or 11%, we're still going to be putting out less than we would have, even if we, from years prior. And so that's, I think, the conversations that we wanted to prepare you for, because it's some hard choices there.
It's a quasi LDI approach, right? As we take from a more mature fund, we're going to.
I call it, and I'll take this guy, Jason Malinowski coined it with some folks at JP Morgan, liability aware. Right? We don't de-risk. We still have a high. Yeah, we have a
Quality of.
But the truth is we have a we still have a high bogey, right?
Yeah.
And so it's not like, unless somebody knows somebody at the state legislature, we get the discount rate drop. We still have a high bogey, so we can't de-risk as it's normally kind of thought of, like a corporate plan. But what we can do is say we can take less risk to get to the same place. I think that's the best way to think of it. Absolutely. So you all will get the copy of all of this as well, but I just want to keep it in mind, we're layering in all of this. And so when we finally give you the recommendation, we've kind of given all the information. And thank you all for an hour. We just need a motion. Has John left already?
So moved.
All right. Technically, with John not here, the meeting just ends. So if we can't vote. So that's the final. We actually can't necessarily adjourn to the meeting ends. But just so you all know this, also the last thing before we go, we've done 1 to 3 o'clock because that's what the previous board did. If y'all have different times you want to do it, please tell us. Please tell us, because 1 to 3 is fine.
We have to start respecting the time frame.
Yeah.
Right? We've not had a meeting stay within a 2 or 3 hour parameter that we scheduled in. It's always going. That's a little easier, and virtual is not. So we're saying we're gonna have a meeting from 1 to 3. We need the hard stop.
It's another one of the gifts I gave.
Right? We have around 4 or 6. We have the hard stop at 6, right? So I'm fine as the board if we figure out a different time, because as long as I have it early, I schedule everything else around it, right?
I knew Michael a little bit.
And we're not even finished with our conversation, right? And so even thinking to what you were just saying about Blackstone and that conversation, and have it be, either we have to get into it and say we're only gonna have a 15-minute conversation and have a 15-minute conversation, right? Or maybe our timing for what we need to talk about isn't accurate. And so we need to start either tapping down what everyone is talking about, or then making different sessions to just discuss these big things and being able to have free conversation, and then come into a meeting that we actually do our stuff and do our work, right? And stuff. So I just say, right now for today, 1 to 3 was fine. It did work out because that's life, right? Life happens when you're sitting in your office and your boss says,
absolutely. No, definitely.
You at 12, like.
No, listen, absolutely. And like I said, we have.
So if we shifted, that's great, but it still doesn't help us if we shift to 3 to 5, and then our meeting is going to 6 or 7. So that's my only thing on our timing and stuff, but especially you done freaked me out now when you talked about the Blackstone next month. And the thing, because then I'm like, okay, that means we ain't gonna get nothing done in a 2-hour period.
And so that could be it.
We're gonna limit our pet meetings